All right, let's do another video update. It's May 30th, 2024, about 11 p.m. We're going to do something different this week. Normally we go through the various macro assets, the charts, talk about the technicals and the relative sentiment, how the smart money's positioned. But today I thought we would look at the various reasons why the market may have topped, and then look at various reasons why the market hasn't yet topped, and then finish by giving our opinion as to whether the market has topped or it hasn't. So let's first talk about the reasons the market has topped. So one potential reason that the market may have topped is that valuations are pretty horrendous. Here's a chart of the long-term expected return of the S&P 500 or the broad U.S. equity market. It's currently at 0.8% annualized over the next 10 years. So basically it's going to move sideways at best from here, but it would have to move sideways for 10 years for it to really be attractive from the standpoint of having a high enough expected return that would be worth buying. So it's unlikely that it would go sideways for 10 years because investors would become impatient and there would be other opportunities for them to earn returns, so they would exit the U.S. equity market and thus causing the market to fall. So valuations are bad. We are at levels that are quite close to the dot-com bubble level, to the everything bubble level. I mean, we're really right in that same ballpark. These aren't levels from which equity markets start secular bull markets. There's no return to be had, and not only is there no return to be had, but 0.8% annualized is much less than what inflation is going to come in at, and it's also much less than what you would earn from owning the 10-year bond. But owning the 10-year bond, you might actually have negative real returns relative to inflation. So equities from a long-term perspective are extremely unattractive at the current levels. They don't have to go any higher to be unattractive. They're currently unattractive. Doesn't mean they won't go higher, but there's no reason why they would have to go higher for that to be a catalyst for the market to sell off, because valuations are already pretty bad. And the equity risk premium is minus 3.7%. So the 10-year bond is giving you 3.7% more per annum over the next decade than holding the U.S. equity market. So that's just really not an attractive risk-return prospect, owning the U.S. equity market. So that might be a reason that the market's topped. Another reason that the market may have topped is NVDA. So here we have this chart. We've looked at this many times. So it had good earnings, or the market at least received the earnings favorably, and it's gone up. It's gone vertical. Today it fell into the close. It was up at 1160 and it finished at 1100 essentially. So about a little bit more than a 5% intraday drawdown. That was based on news that the U.S. government is restricting NVIDIA's sale of chips to the Middle East at large scale. So, these gaps will almost certainly get filled. There's a gap here, gap here, gap here, one here, and then one all the way down here. I believe those gaps will get filled. This thing's gone vertical. It could easily pull back and fill those near-term gaps. You have Chinese competitors that are, see the 75% margins that NVIDIA has. A lot of people see those 75% margins. They want to jump in and compete and create, cheaper chips and take some of that market share. So I think, we may be witnessing the top here in NVIDIA. Maybe not. Maybe it goes even higher. But I do think that AI will end up being more hype than the panacea that it's being made out to be. It seems like there could be issues with monetizing AI. I personally use it a lot, or attempt to use it a lot, and I end up wasting a lot of time, it seems, using it, because it often never provides the right answer, or provides a completely erroneous answer, or it doesn't write the right code, or it pings back and forth between errors. It fixes one and institutes another, and then fixes that one and reinstitutes the initial error. So I'm dubious about the prospects of AI and relative to how AI stocks have been priced. I mean, eventually it might, work out well, like the internet worked out well, but how stocks were priced in the year 2000 didn't work out for many people because they got ahead of themselves. So I think that's probably the case with AI. So NVIDIA, and if this thing does pull back, and if you go straight up, oftentimes you come straight back down. That could be a reason why we may have topped. Another reason why we may have topped is that market breadth is pretty bad. So the NASDAQ has made a new all-time high recently, but the number of stocks in the NASDAQ above their 50-day moving average keeps going lower. The higher the NASDAQ goes, the fewer number of stocks that are above their 50-day moving average in the NASDAQ. That doesn't seem like a really good situation from a sustainability perspective. Same thing with the S&P 500. The S&P 500 made a higher high, but the number of stocks above their 200-day moving average, the number of stocks above their 50-day moving average, both are moving lower as the index moves higher. Again, that doesn't seem like it's the most sustainable situation. We also have negative momentum. So the relative strength index, the RSI, it's moving lower while price is moving higher. According to this chart, that's happened many times in the past, and it's preceded major volatility episodes where the market's pulled back substantially. So that might be another reason we have already topped. Yet another reason is that we have the Dow Industrials, which has tumbled pretty strongly in the last few days. The S&P is a little bit off its highs, but the Dow Jones is way off its highs, and the Dow Jones Transports never actually made a higher high, which I'm not a student of Dow theory, but I believe if the Dow Industrials makes a high, but the Dow Transports don't corroborate that by also making a new high, that is a conflict that is basically a red flag. And as you can see, the Dow Transports have been moving lower since February, and while the Dow has been rising into May and the S&P has been rising into May, so that situation might mean that we could have topped. Here we have the relative performance of the consumer discretionary sector, XLY, over the S&P 500, SPY. Now, in a situation where you have a risk-on phase in the market, where growth is solid, where the consumer is resilient, and by all accounts, the consumer has been resilient up to this point, and growth has been fairly robust up to this point, you would expect the consumer discretionary sector to be a leading sector. But as you can see, it's making new 52-week lows versus the S&P 500. What is actually rising is consumer staples and utilities, and those are defensive sectors. Those are sectors that people buy when you're in a recession or growth is slowing. So those have been doing well lately, whereas stocks that you would expect to do well if we were truly in a bull market risk-on phase are not doing well. So that could be an indicator that we have already topped. Here we have the U.S. 10-year interest rate, the candle chart, and the line chart is the U.S. 30-year interest rate. Now, as you can see, these interest rates rose pretty strongly in 2023. It got to the point that the S&P 500, the NASDAQ, equity indices were in free fall in October of 2023. But then Yellen pivoted whenever she announced the Treasury issuance for the subsequent quarters. Instead of issuing long-duration bonds, she shifted a lot of the issuance to the short end, to T-bills. So if there's less supply in the long end of the curve, then those interest rates can come down, and they came down very strongly. The 30-year was over 5%, and the 10-year was at 5%, and they both came down into 4 and 3.8. Actually, looks like the 30-year actually briefly went below 4. But from December of last year onward, they've been rising. Now they've been rising because of strong economic data and hotter than expected inflation throughout the early parts of this year. And they've been rising quite strongly in the last few days. The 10-year got over 4.6, I think it was at 4.65, 4.67 a couple of days ago. And the 30-year was at 4.75, 74, in that ballpark. Now they fell today. Not entirely sure why they fell today. I think there was some data early in the morning that the market took favorably. But as you saw, the market sold off today because NVIDIA sold off, and that's such a big weight in the index, and it dragged the broad market down. Small caps were up, but they've been actually horrendous leading up to today, so that's not really anything to hang our hats on. Interest rates rising, not good for equities. As you can see, the equity risk premium, it just keeps getting worse and worse because there's more return likely to be had long-term from bonds at this point than from equities. So that might be a reason why we've topped. So now let's look at the reasons why we haven't topped. So tops can be multi-year, multi-month processes. Now this is a chart, a quarterly chart. So each candle here represents 3 months. And if you look at these various tops, it takes several candles, upwards of 5 to 8 candles before the thing you can definitively say, okay, yes, we've topped here. That was a major top. 5 candles is 15 months, 8 candles is 24 months. So it could be a long, drawn-out process for this market to top. Another reason why we may not have topped is that in November of last year, whenever Yellen pivoted the Treasury issuance, we had a Zweig breadth thrust. That's when the number of stocks, I think below a certain moving average, or I can't really remember the exact details. Oh, there it is. It's a 10-day moving average of the advancing stocks normalized for the number of total stocks goes from below 0.4 to above 0.615. That's what it is. It's down here. So when that happens, it's happened, I think, 25, 23 times since 1945. The market's been up every time 12 months later. Now, the market is up substantially from when this thing triggered in early November, probably up 20% from that point. So it doesn't necessarily have to go higher from here, but we still have a 5-month window. So it triggered November 3rd last year. 1 year later would be November 3rd of this year. The election's on November 5th, so November 3rd must be a Sunday. So conveniently, this thing could potentially rally within this bullish window up to the election. Maybe the election is the high. So that's another reason why we potentially haven't topped. We still have many months left on the after effects of this Zweig breadth thrust. Also, the Fed is dovish. There was really no reason for Powell to pivot in December of last year from an inflation perspective. Now, you can say there was a reason for him to pivot from a U.S. fiscal situation perspective. They didn't like what they saw in October as interest rates were rising with no cap and equities were falling with no floor. They need equities higher for tax receipts to keep the deficits in check. If equities fall, tax receipts fall because capital gains taxes fall, and they're not going to cut spending, so that means deficit is going to rise, which means more Treasury supply, which means interest rates are going to rise further, which probably means equities fall further, and you get into this doom loop. And they wanted to avoid that, so Powell pivoted, and then as inflation came in hotter than expected this year for 3 consecutive months at least, he stayed dovish. And most recently, he's essentially said, look, we're not going to raise rates anymore. Unlikely. There's a huge, a high bar for us to clear for us to raise rates again. But we're looking for reasons to cut rates. So there's this dovish asymmetry in the Fed's current monetary stance, which is basically saying that, they want asset prices elevated, they want interest rates down. And the Fed, I wouldn't necessarily bet against them just yet. So that might be one reason why we haven't topped. Now here, this is a tweet from earlier today. It says that Yellen's pivot is fading. So, she shifted the issuance to the short end of the curve, less at the long end of the curve, but now apparently not as much at the short end, a little bit more at the longer end. I didn't read this article, so I don't know exactly what the person is saying, and he might say, well, okay, that's bearish, so that's not a reason why we haven't topped. This is almost like a placeholder. So my bigger point is that Yellen is part of the administration, so she wants the administration to get reelected. And she's probably has other levers that she can pull as we get closer to the election, so she could probably pull another rabbit out of her hat. But also, if you look at the markets like a movie plot, for a movie to be good, the plot has to have some conflict, some tension, some adversity for the protagonist to triumph over. Same thing with markets. It would be almost impossible for them to have run this higher in a straight line from last November to this November into the election. So there has to be some drawdowns along the way to keep people honest. And maybe we have weakness in the near term because all these negative divergences with breadth and momentum and non-confirmation with the Dow Transports and the consumer discretionary. Maybe we do have some early summer weakness, but then perhaps the market stabilizes, perhaps the Fed has a green light to cut rates, perhaps Janet Yellen spends down the Treasury general account, which almost functions like quantitative easing, and they juice the market into the election. So, and then we potentially make higher highs then. So that's another reason we might not have topped. And then lastly, we have Biden releasing 1 million barrels of gasoline from the gasoline reserve, which just kind of puts an exclamation point on the notion that they're going to pull out all the stops, do whatever they can to keep asset markets elevated, to get inflation down, to get gasoline down, to keep oil prices in check, to not escalate in the Middle East, etc. So there's huge political will to keep markets elevated, and that might be a reason why we haven't topped. So where do we come down on this? Well, I think the arguments for why we have topped seem to be stronger. I think that a lot of those charts I've showed earlier, I think they have some substantial weight to them, and I think that ultimately the market will succumb to those divergences and unsustainabilities. But, and also I would say that the smart money is buying the dollar, they're selling gold, composite equity relative sentiment is bearish. It's not enormously bearish, but it's on the bearish end of neutral and sort of on the cusp of being solidly bearish. So that might lead to some near-term weakness. But I don't think we've topped just yet, because I do think that there's enormous political will and perhaps political need for the U.S. fiscal situation for the Fed and the Treasury and the White House to keep asset prices elevated. I do think that tops are processes. It's hard for me to believe that they won't try to juice equities at least one more time into the election. So I don't think we've topped just yet. However, if we get above 5,400, get above 5,500, and are pushing 6,000, then I would think that the next big drawdown from that point on might mark the ultimate top, and it could be a major, long-lasting top that we might not revisit for many years. So that's where I come down. I think we haven't topped just yet, although the arguments for why we have are pretty solid. So let me know how you feel. Have we topped? Have we not topped? What did I miss? What should I have included? And if you have any questions, I'd be happy to answer them. And thanks for watching.